Welcome to the latest in Fitch's series of global virtual investor meetings. We have one-on-one meetings with hundreds of investors each year and want to give you a glimpse inside these meetings. I'm Rui Pereira and I head up Fitch's North American Structured Finance team here in New York. I'm thrilled to be here today with Kevin Kendra, who heads up our U.S. Structured Credit Group. So welcome, Kevin.
Thank you.
Kevin, let's start by focusing on sort of the broader aspects of the market. What's the state of the leveraged finance market? What risks are you starting to see emerge at this point in the credit cycle, and how are you accounting for those risks in your CLO rating analysis?
Right. So fundamentally, corporate credit fundamentals remain strong. So we're seeing positive earnings growth on the back of positive GDP growth in the U.S. economy, and Fitch's economists forecast positive GDP growth for the next 2 years. So fundamental credit, things look good. However, we're starting to see some late cycle credit behaviors really driven off of supply and demand imbalances in the loan market. We're seeing kind of a lack of new credit creation in the loan market. The loan issuance we're seeing is predominantly refinancings or repricings of existing loans. And on the CLO side or in the retail fund side, we're seeing lots of new demand for leveraged loans. So that's allowing borrowers, or a more issuer-friendly environment for borrowers, and they're getting things like upticks in kind of first lien leverage metrics. We're starting to see some looser documentation standards with allowances for incremental debt facility baskets or EBITDA definitions. So there's definitely things for us to be watching and to be concerned with. On our CLO analysis, what we expect to see the upticks in kind of first lien leverage really impact the credit quality of the underlying portfolio over time if that continues to, going unchecked. Similarly, things that would be incremental baskets that would have an impact on recoveries, et cetera. We would see things like increasing CCC baskets and some other metrics there. But most of that will really have an impact on the lower rated CLO debt tranches. The senior CLO debt tranches, where Fitch assigns most of its U.S. CLO ratings, really shouldn't be impacted.
Great. And let's stay on the credit theme. And when I look at CLO performance, performance has been very, very strong. Even in pockets where there's been some stress, be it in the energy sector or more recently in retail, the structures have proven resilient. There really hasn't been much of an impact on CLO performance or the ratings themselves. But as we get deeper in the credit cycle, what sectors are you focused on or are you potentially concerned about?
Right, so Fitch's Leveraged Finance Group maintains a 3-tier kind of loans of concern list. The first tier being issuers that are at risk of default in the next 12 months. That list is still dominated by retail and energy exposures. So what we expect in the short term will be continued stress from those sectors that are in kind of a secular decline. Longer term, we start to look at things like business services and technology type companies. Those are areas that we're focusing in on to see really do we see signs of distress in those markets. One of the things that we do see when we look there is a lot of those companies, the performance drivers will be varied. For instance, a business services company catering to the energy sector will probably have a performance more similar to energy than it will others within the business services sector. So really those are the areas that we're focusing on to trying to find signs of new stress, but we really don't see systemic stress throughout the portfolio. We think it's going to be idiosyncratic defaults that we see based on failures of current business models.
Great. Let's talk a little bit about volume. So two of the big stories thus far in 2018 have been the surge in U.S. CLO issuance, as well as the rollback in risk retention. So talk to me a little bit about what's driving U.S. CLO issuance. Is it sustainable? And also, what do you think the broader implications are from the risk retention rollback?
Right, so you're absolutely correct. The CLO issuance has been very robust so far in 2018. To put it into context, the first quarter of 2018, issuance was more than double what we experienced in 2017. So we're certainly seeing increased volumes, and we do expect that to continue. In 2017, issuance was over $100 billion. So we're on a run rate to far exceed that in the U.S. market. A lot of the issuance that we're seeing is also reset and refinancing activity. So CLOs that were originally issued in 2015 and 2016 have a much higher cost of capital or cost of funding in those portfolios. Those transactions are exiting their 2-year non-call period. A 2016 vintage CLO may have senior debt priced at LIBOR plus 150 or higher, and they can probably refinance that closer to LIBOR plus 100 if they're looking to kind of just reissue that CLO. So we're starting to see a lot more activity on that front as well. A lot of it's driven by the increase in the risk retention rules that you saw. So risk retention fundamentally changed the CLO market. We saw CLO managers go out there, and when they looked to solve for risk retention, they went out and they raised third-party capital to finance their entire CLO platform, not just one CLO at a time. And that capital is actually staying in the market. We're not seeing a mass exodus of that. So we have the development of a long-term, stable kind of CLO equity investor base, or an increase in the equity investor base. We have a lot of increase in demand, both domestically and internationally, based on where current interest rates are at. And that's allowing for the market to continue to grow. Longer term, we expect that the removal of the risk retention regulations to allow for smaller, more independent managers to re-enter the market. Therefore, we expect to see an increase in the number of managers that are actually participating in the U.S. CLO market.
Thank you, Kevin, for joining me and sharing your thoughts. Next up in our series will be virtual meetings with our global colleagues, so watch this space for new content. If you have any questions on any of the topics that we discussed, please send us an email to the address on the screen. Thank you all for watching.